Greetings, everyone. Thank you for joining us. We're going to wait just a minute more before our official start, but we're happy to see you here, and we look forward to spending a few minutes with you.
Should be fun. And I see that folks are still trickling in. Looks like we may have started to plateau. Dave?
We stabilize there.
Start?
Good. Okay. Well, let me say again, greetings and thank you for joining us. I'm Dave Yeske. I think most of you know that. Most of you know all three of us. I am joined today by Yusuf Abujaderi, who is who is a partner at Yeske Buoy and also our Chief Investment Officer, and Lauren Morellis, who is another of our partners here at Yeske Buoy. And she is going to be, I guess I'm thinking you're the audience advocate today. She'll make sure that as Yusuf and I move our way through what we have to share, if you have any questions or comments, Lauren, are we going to be using the Q&A or the chat or both? What should people be doing?
Yep, either one. Both are open, and so you can submit any messages through either function, whichever's easiest.
Excellent. And you can be sure that Lauren will catch them, and as appropriate, she'll slot them to Yusuf and I to give whatever commentary we have to give. Hopefully good answers to whatever your questions are. We'll also share comments as you provide them along the way. So Yusuf has put together a couple of interesting stories about where we've been and some of the things we can look forward to in the coming year. And I'm going to let him primarily tell that story and be here to provide color commentary. So take it away, Yusuf.
Thank you, Dave. So we'll start with just a review of our agenda today, give you a roadmap of things we'll be talking about. We'll look backward first, and so give you a review of 2023, some of the stories there that we'll be focusing on, how stocks performed, how bonds performed, how U.S. stocks performed relative to international companies. And then, of course, everyone's been talking about the Magnificent Seven, some of the biggest tech-focused companies in the U.S., how they did relative to the other 493 members of the S&P 500. And then we'll turn our focus forward, and we'll look at what we might be paying attention to as 2024 unfolds. And we'll tell those stories through the lenses of a few economic indicators that we're always watching, but we'll provide some fresh commentary there. But first, a look back at 2023 and what a year it was. We could start just by saying that our portfolio, our equity portfolio, the stocks that we manage, grew by some 17 or 18% in 2023 and leave it at that. But we'd be missing on all of this action that occurred leading up to the tail end of the year. So let me grab my cursor here and we'll spend some time just kind of looking at what occurred through the first half of the year. And you can see the portfolio by the end of July was up some 13%. But what changed at that point? Well, Chairman of the Federal Reserve, Jerome Powell, started using the phrase higher for longer about where interest rates were going to remain with a higher degree of frequency. And this notion of interest rates remaining higher for longer seemed to put a little cause for concern amongst investors, wondering how long interest rates were going to remain higher, and therefore how long things were going to remain that much more expensive as things have gotten more expensive with interest rates coming up. And as investors were pricing in those updated assumptions, well, we started to see the prices of the stocks that we own coming down a bit, all the way to the point where at the end of October, the returns for our portfolio for the year were 0%. We did not find this as a cause to panic. We continued to let the information roll in and continue to manage the portfolio as we do diligently. And we're gratified to see that in the last 2 months of the year, stocks shot straight up. And it had a lot to do with the rhetoric around interest rates softening. What drives that rhetoric, or one of the drivers, as has been for the past couple of years, are inflation rates. And so we've been seeing inflation rates continue to come in lower and lower and lower. All the while, employment numbers, and of course, the Federal Reserve manages both inflation or interest rates to manage inflation and unemployment. And so with indicators being positive from both of those spaces, the notion of having to keep interest rates higher, that actually started to become less and less a part of the conversation. As the Fed backed away from that, well, that gave investors a reason to be optimistic. If things are going to get cheaper going forward, the stock market is going to price that in. And we saw that happen as prices shot upward and ended the year, as we said. The stocks in our portfolio were up almost 18% for 2023.
And as always the case when it comes to the economy and the markets, these are complex, chaotic systems that, they aggregate out to something that we can measure, but we don't always know exactly what's going on beneath the surface because, as Yusuf referenced, higher interest rates have run the risk of causing the economy to slow down, which could cause companies' earnings and profits to slow down. But there's another piece, and that is that investors, to some degree, price the value of a company's stock in relation to interest rates. That becomes one of the inputs into actually looking for an intrinsic value for a stock. So lower interest rates, all other things being equal, generally lead to higher stock prices. So that was the other thing that investors are looking at, is if interest rates are going to come down, it bodes well for continued strong economic activity, and it also it feeds into the stock valuation number and potentially makes stocks more valuable.
Absolutely. We'll pivot now and talk a bit about bonds, but before we can go through the discussion that we've prepared about bonds, we wanted to have a brief, maybe reintroduction or review of what a yield curve is. So bonds are debt instruments. When you own a bond, it means that you've purchased it from someone. You are loaning them money. You are then promised an interest rate for the term that you hold that bond. Typically, the longer the term, you can see that along the x-axis down here, the longer the term for a traditional yield curve, and that's the orange marker here, your yield should go up, meaning that if I'm loaning you money, the longer I have loaned that money to you, the more I should be compensated as a lender. So you would expect in a traditional situation that the longer the term of the higher the yield. However, presently, the yield curve is inverted, meaning, and this is now the blue line that we'll focus on, these are the actual rates of return or the actual yields that you can get by owning government debt, U.S. government debt, or a treasury bill. Right now, the highest return available is with a 3-month treasury bill. And as you start to go out, the yield comes down. Now, why is that the case? The expectation is in the future, interest rates are not going to be as high as they are now. And so for longer term debt, we're seeing yields that are lower, in line with the expectations that although interest rates are high now, at some point in the future, they'll be lower than they are today. So why is that relevant information when looking at the performance of bonds over the past year and change? We're charting performance here from October of 2022 through the end of 2023. We picked that range because the Fed last raised interest rates towards the end of the summer of 2022. So we started with the beginning of the next quarter, and we're looking at performance since. And bond performance has been strong. So this is a 5-quarter period with the 2 bond funds that we use most prevalently in our clients' portfolios, both up by more than 5, approaching 6% over a 5-quarter period. Really strong performance, especially in relation to what we were seeing in bonds in 2020, 2021. When we look at what the underlying investments in the 2 mutual funds that we're highlighting here are carrying, This is the part that relates back to the yield curve. So as of January of 2023, so if we look back a little bit more than a year ago, we look at the underlying bonds within the 1-year fixed income fund, and the average maturity was 0.8 years, right? So call it 9 months or so, which means that the bond fund managers are buying up short-term bonds, 3-month, 6-month, 9-month bonds. If we look at the 5-year global fund, which in and of itself, you can see it in the title, it can have underlying maturities that get us close to 5 years. Those fund managers are also maximizing return by going short. The average underlying maturity a year ago was 1.6 years, or a year and a half. If we look at how the fund managers have continued to try to maximize yield, and recall, in the inverted chart, the highest yields available are somewhere between 3 and 6 months. Well, look at the underlying maturity now. A fraction of a year for the 1-year fixed, and a quarter of a year, 3 months for the 5-year global fund. So the fund managers are observing the environment and saying, okay, the way that we can best maximize returns for the bonds that for our investors is to go short term and capitalize on the available yields. And they have that flexibility to take advantage of the environment. And as yields go, as rates go down, that actually pumps bond prices up. And so the bond funds have been positioned well to take advantage of the past 15 months. And when rates start to come down, they're that much better positioned to capitalize on that as well. So strong performance in the bond market over the past 15 months. So with the 2 high-level looks at stocks and bonds behind us, let's spend a few minutes now kind of drilling down into returns by asset class. And so 2022, as we recall, was a tough year in markets. 2023, much stronger. Best performer, the S&P 500, and we're going to pick on the S&P in a couple of slides, so we're going to move on from there. Gratified to see emerging markets doing really well, up by nearly 25%. And as we've said in past webinars and as readers of our digest know, we tilt our portfolio in favor of value stocks and small company stocks. And so seeing the words small and value in the next best performing funds, really encouraging, because we've tilted our portfolio in favor of those aspects of the market, or those segments rather, and our clients are benefiting from those returns. And then you can see the rank order from there, with global real estate as the worst performer. And in a year like 2023, the worst performer returning 9%, not bad. But now we'll focus on the S&P 500 because it gets all the headlines and it generates a lot of the questions that we have to answer. Its performance generates a lot of the questions that we have to answer for our clients. In 2023, the S&P 500, which is an index that tracks the 500 or 500 of the biggest companies in the US, was up some 26%. Much of that performance, however, can be attributed to 7 companies, or the Magnificent Seven. So Apple, Amazon, Meta, the artist formerly known as Facebook, Netflix, NVIDIA, Amazon, and I'm forgetting one at the moment, forgive me. Those 7 companies represent 1.4% of the S&P 500 if you were to stack 500 names, right? But they account for 40% of the return. And how do we know this? If we remove the 7 companies, that Magnificent Seven, from the contingent, and we track the performance of the remaining 493 companies in the S&P, well, the S&P 493, this fictitious index, was only up by 15% in 2023. So that 7 companies can account for 40% of the return of an index indicates some skewness. And while we own the S&P 500 in our clients' portfolios, and we think it's an appropriate way to get exposure to the growth that's happening amongst large US companies, we're not going to chase returns that are being purported by just 7 companies. That's not investing. That's returns chasing, and it's just not something that we're going to do on behalf of our clients. But when we are able to break down the returns and see this kind of a disparity and attribute this much of the performance to just 7 companies, it says something to us. It's worth paying attention to, and it's worth understanding the context behind that. And so we'll be spending some time in the coming slides and breaking that down in even further detail.
And this
Then,
is
of course,
actually,
you can see, go ahead,
I'm
Dave.
sorry. I was just going to say, and the thing about the S&P 500 is that, as is true of many indexes, it's a weighted index. So as the price of a company in the index goes up, that company comes to represent a bigger proportion of the index, which causes its returns to be magnified. And this is not the first time that technology has eaten the S&P 500. Back in the 90s, the S&P 500 went, from the beginning of the 90s to the end, it went from representing like 13% of the index to representing a third of the index. And in recent years, with first the FANG stocks, the 5 FANG stocks, and then later the Magnificent 7 that Yusuf's been talking about, it sort of has repeated that, where these companies have had such a surge in prices that they've come to represent, I think, again, about a third of the index. And therefore, every time they produce a return, it has a much bigger impact on the index return because it's weighted with such a bigger proportion than it used to be. And we won't talk about what happened at the end of the dot-com era. We're not making a prediction about the Magnificent 7 other than to say they're kind of expensive right now.
And we have a slide about how expensive stocks are that we'll go through in just a moment. One of the things that we wanted to look at here, however, is as we think about U.S. stocks and why we want to make sure that we operate a globally neutral portfolio. Let's not let this part of the presentation sound like we're down on the U.S. Not at all. We want every country out there to take up its appropriate share of our portfolio. The reason being is you can't predict where any one country is going to stack up relative to the rest before the fact. After the fact, of course, we can assess how returns, broke out. This chart is showing you how the U.S., which is represented by the blue line here through the gray area, performed relative to all the other countries out there. So the gray area represents the difference between the best performing countries' returns and the worst performing countries' returns, again, over the past 50 years. And in so many years, the U.S. kind of is middle of the pack. I mean, there are absolutely instances. I'm pointing at one here.
The dot-com era.
and maybe here towards 2021 or so, where the blue line ekes up to the top of that gray area here again, maybe in 2016. But we can contextualize this performance. We understand why the U.S. has moved towards the higher end of the area in recent years. And we also appreciate that that's not the full story. So 2 major contributors, if we just isolate, we should talk about the dot-com meltdown in just a moment, Dave, but if we isolate the financial crisis of 2008, and we note from here the U.S. was middle of the pack, kind of moved up a bit here and here, but really started to take hold of that upper ranking towards the end of 2016. In 2017, well, of course, recall that with the Tax Cuts and Jobs Act of 2017, corporations in the U.S. benefited from a tremendous cut in their tax rate and were therefore flush with cash and were able to buy back their own shares to pump up their own stock price as a result of a policy change. No commentary on the ethics behind the choices, but the fact of the matter is that was a driver in inflating the stock prices of U.S. companies. In addition, since 2008, for much of the period here, all the way out to the end of the chart, interest rates have been at 0. So as Dave was mentioning, many of those large growth companies, the headline grabbers in the U.S., benefited tremendously from a 0% interest rate environment, which also helped them to grow at rates that took the overall returns of the U.S., again, because we're seeing price-weighted measures here and larger companies maybe skewing returns a bit, we're seeing the U.S. rise to the top in recent years. And so we can contextualize that and understand that while that is an observable fact, it's also true that it may not be a phenomenon that persists indefinitely, and therefore, just because you've seen good performance recently doesn't mean you change your approach on a going forward basis. We know that as recently as just 15, 20 years ago, the US was at the bottom of the rankings, and that was in direct response to a downswing after the dot-com meltdown, and went through a period where, from 2000 to 2010, oftentimes called the lost decade, returns were pretty abysmal. Domestically, internationally, not the case. And so again, because you can't predict these outcomes ahead of time, it makes sense to diversify.
But they are
But we wanted to make sure
cyclical.
that
Yeah, I mean, the thing is, there are two things that can cause the price of stocks to go up, whether it's an individual company or a collection of companies. One is the market, investors can be paying a bigger multiple for a given dollar of earnings. And the other is that earnings go up. So, if investors on average are paying, are willing to pay $15 for a company that has $1 of earnings, then the company will be at one price. And the price can go up either because its earnings have gone up, so it's a higher level of earnings being multiplied by 15, or because the multiple has gone up. Investors are willing to pay even more for every dollar of earnings. The US is in a period now where investors are paying more for a dollar of earnings here in our market than in general they are in overseas markets. But these things tend to be cyclical, as this chart is an attempt to illustrate.
We've got more commentary in that area. The similar chart to what we saw breaking out performance in the S&P 500. What we're looking at here are international stocks. So the red column, ACWX, that's the All Country World Index, ex-US, so international stocks around the world. When we remove the 7 largest companies from that index, you can see the returns don't change nearly as much, a difference of maybe 1.5%. And so an appreciation that when we think about the international component of our portfolio, it's less concentrated, and so we can appreciate the benefits of more broad diversification here. And in terms of valuation, and now we'll go to the next slide, and this is what Dave was alluding to, there's a lot of value to be gained by investing internationally. So first, what are we looking at here? The chart is showing 3 measures of valuation, or how expensive stocks are, as a measure of what amount of a company's assets you are buying for the price of $1. Right? So the price to book ratio, $1 buys you X amount of a company's assets. And this is a measure of how expensive the company is. So when we look at the dark blue line, which represents the US market.
Or Yusuf and I would just flip that. How many dollars you pay for $1 of assets?
Excuse me. Thank you. Thank you. Sorry, Dave. Thank you for the clarification there. So we look at the US, and you can see that it's at the top of the area, top of the chart here for most of what we're seeing here. But let us remind you that this is a measure of how expensive the stocks are. Higher is bad on this chart. You don't want to be higher. That just means the stocks are more expensive. The last time that we saw stocks climb this high, and Dave, you alluded to it a couple of times here, was right before the dot-com meltdown. So valuations skyrocketed some 25 years ago, and then took a dive as, again, the cyclical nature of how these systems operate came to bear.
And it's important to note that we're never making a prediction about what's going to happen. We're not saying, well, in the past when things got expensive, they subsequently got cheaper. Although that has tended to happen, but not in a predictable fashion. Really, I think that, as much as anything else, the point is that when things get expensive, on a forward-looking basis, there's probably less upside potential, maybe more downside.
Right, exactly. It doesn't make sense to buy more of that thing that's become more expensive, not more than you were planning to anyway. So our last slide here, before we start moving on in our presentation, is just to look back over the past couple of years. Within the context of everything that we've touched on, how has our portfolio performed relative to the benchmarks against which we measure ourselves? The All Country World Index, which is a global index, is our benchmark. We've outperformed it significantly over the 2-year period beginning in January 22. We've outperformed the S&P and done better than the All Country World Index ex-US, international stocks. There's the NASDAQ, by the way. The point here is that by being as broadly diversified as we are, our portfolio has been able to weather the tougher segment of 2022 and capitalize on enough growth through the end of 2022 and into 2023 that has done really well comparatively. And again, just gratified to be able to report that back to our clients.
Yeah, and that's one of the things that's worth noting is we're looking at a two-year window here. And while it's true that the S&P 500 was one of the best performing categories in 23, it was one of the worst performing categories in 22. And therefore, on balance over that period of time, it actually did less well than a more broadly diversified portfolio.
Yeah, and it's even more true with the NASDAQ. I mean, the NASDAQ was up some 40% in 2023, but it was down by enough in 2022 that it's still
down for the 2-year period. Yeah. Yeah, there's a lot of volatility. And the NASDAQ is often referred to as a tech-heavy index. And it does have proportionally, it's always had a lot more tech stocks in it than the S&P 500, for example, even though tech was eating that index.
You can't say tech these days without talking about AI. And so here we are. We wanted to share a bit more context behind, what's been happening in the U.S., what's been driving those returns. Obviously, AI has dominated the headlines for the past several months and maybe even past, a year or so. We wanted to just share a few thoughts here. Understand that we are aware of the buzz around AI, and we're also already aware that it's been a part of the landscape for a long time. I mean, machine learning is built into most of the apps you use on your phone or on your watch. If you have Alexa, running on any of the devices in your home, there's some AI built in there. We could go on and on down the list. So it's not like AI is coming. It's here. It's part of your life, and it may be a growing part of your life going forward. So many of the conversations that are being had are trying to assess future implications. What does all this mean? We see these companies that are investing in AI growing really rapidly. But what's AI going to do to me? And this was a conversation, Dave, that we were having yesterday. I could quote you, or I could just turn it over back to you and give you this bullet here.
No, I don't know. I mean, everybody jokes about, all the Terminator fans joke about asking the question, when is AI going to cause Skynet to become sentient? And the funny thing is that, in the Terminator series, Skynet was put in charge of all of the military assets, which is what made it so dangerous when it decided that human beings were pests. And you could say, well, that's not going to happen. But in fact, military applications are what everyone's most interested about. At least governments are most interested about when it comes to AI. So I think we'll see some of that. But in reality, I mean, it looks like AI, AI is one of those self-canceling things to some degree. To the degree it may have a dark side, it also, AI can be used to combat that. As I was saying to Yusuf yesterday, I teach at Golden Gate University, and I have for many decades. And with the rise of the notable rise of AI in the last couple of years, like with OpenAI coming out with ChatGPT and so forth, people in academia were concerned that students would be able to use these chatbots to write their term papers and do all of their forum postings and so forth. And indeed, students have done that to some degree. But what happened at the same time is that the university offered the professors AI-based tools that could detect the presence of AI output. And so we had websites where we could take a term paper, or we could take a posting on a message forum, and we could submit it, and it would tell us whether or not it was generated by a human being or a machine. And I did a lot of testing of it, and it seemed to be pretty accurate. I tested it by putting stuff I knew had been written by humans through it, and putting stuff that I had actually generated by asking ChatGPT questions. And the output looked like human output to me, but every time I put it through some of these machine detectors, they successfully said, no, this was machine output, this was human output. So, and that also is true to the degree. I was just having a conversation with our tech consultant, and we were talking about AI and the fact that AI has created a lot more threats around identity theft and malware and all of these cyber threats that we face. But at the same time, there's good AI that's being developed right side by side with it that's being used to offset that. So we're probably going to be in a perpetual battle between the white hats and the black hats where artificial intelligence is concerned. Thankfully, I mean, if we're going to have the rise of the black hats, we have to have the rise of the white hats. And it'll probably be a stalemate for the foreseeable future.
Thank you, Dave. And just in terms of what we're continuing to watch, we're watching just like you are at home. We want to be up to speed on what's out there, what's developing, what the conversation is around regulation, and just being aware of how that's unfolding. And then I'll just share a couple of thoughts about where my head goes. And this came actually from a conversation I was having with a client a couple of weeks ago who happens to work at one of these Magnificent Seven tech companies. His comments were that the thing to watch now is that companies are just competing against each other for computing space, or computing power rather. And how are they doing that? Well, they're investing in land and building up data centers. And I was sharing that with Dave yesterday. It's wonky information that's interesting to me as an economist, trying to understand how companies are maximizing on, the resources that they're using in their processes. So all that's to say, we each have our own perspective on it. We each have our own experience with it, and we're all talking about it. And we just couldn't have a conversation with you all, our clients, without making it known that this is on our minds. And while we appreciate how it may be influencing portfolio returns, we're also just aware of the broader considerations as well.
And as speaking as someone who has a great interest in the economic health and well-being of the city of San Francisco, I will say that while you've probably all read about the high vacancy rates in San Francisco office space, that has started to turn around, but all of the new space is being taken up with AI-based companies. So, it was computing technology back in the 90s, and then later it was social media. So many of the social media companies were founded and headquartered in San Francisco, and now it's AI. So it's always the rebirth of whatever the next big thing is. And so we can look forward maybe to seeing some good impact from AI, at least on office vacancy rates.
Just funny how, Silicon Valley is just down the road from our San Francisco office. And here in Vienna, Virginia, I drive through, Data Center Alley every day on my way to work. I probably pass 15 of them. So we're in the thick of it, physically, regionally, on both sides of the country here. So we've done our look backward. We've talked about financial markets. We've spent some time being futurists, talking about AI. And now we're going to look forward a bit. And we're going to talk about what we're thinking about, what our outlook is going into 2024. And again, we'll begin by just reporting on one of the things that people have been talking about for the past couple of years. Well, we're headed for a recession. Are we headed for a recession in 2024? We're not going to make any prediction, but the indicators don't seem to be telling that story. In fact, the U.S. economy grew faster than expected in the last quarter that just closed at the end of 23. And it's been several quarters of growth, which is the exact opposite of what a recession is. A recession is oftentimes defined as 2 consecutive quarters of economic contraction. No one has called the first 2 quarters of 2022 a recession yet. But if we look back at economic growth as charted by gross domestic product over the past few years, we'll let the chart speak for itself and just say that as you digest this, we continue to feel good about the health of the U.S. economy based on the information available. One of the stories we said we would focus on today as we drill down into some of the economic indicators we watch and that influence our outlook. The Fed, as you know, is responsible for manipulating interest rates to try to maintain the health of the economy. The things it watches, and of course it does more than manipulate interest rates, but that's what headlines are focused on these days. The dual mandate the Fed has, its primary responsibilities are to manage two things: employment and inflation. And so when we look at the unemployment rate hovering around 3.5% over the past couple of years, that's fabulous. When we see that even though the Fed has been raising rates consistently, and even as we've seen the economy, inflation come down, and yet the economy still continue to grow, we're also seeing jobs created, which it was thought was an impossibility, that if the Fed was going to be slowing the economy down as much as it is, raising interest rates and trying to curb growth a bit to tame inflation, well, then certainly job growth would have to fall out, and completely collapse. And that just hasn't been the case.
There were
It
a
has
number of,
slowed.
yeah. No, I'm sorry. I was just going to say, when I was first in graduate school studying economics back in the 90s, the classic theory at the time was that the relationship between interest rates and employment was so they moved so much in lockstep that and likewise with inflation, that many people trained probably at the same time I was in the last couple of years were saying, oh, we're going to have super high unemployment, and we're going to have it for years before we can tame this spike in inflation that we saw in 2022. And it turns out that it's not, I don't think it's entirely to the credit of the Federal Reserve, although I think the Federal Reserve has been a good manager of the economy, but it sort of indicates I think how robust the US economy is right now, that you could actually have interest rates go up and the predicted outcome of inflation coming down, but without unemployment going up. That relationship is completely at odds with what we would have expected 20, 30 years ago based on the best available thinking. So it's the Goldilocks economy, and we're happy about it.
I wish I had actually designed this slide and the next as a side-by-side, because the juxtaposition, as you just talked about, Dave, is so clear. I mean, here's inflation in purple, or in orange. Purple is CPI, the Consumer Price Index, which is the headline inflation number we see reported monthly. The Fed also looks at PCE, the Personal Choice and Expenditures Index, to get a sense of personal consumption expenditures, I should say, index, to get a sense on prices. You can see the spike that Dave was alluding to, inflation peaking, the CPI at 9% in the summer of 2022. And right around then, that's when the Fed started hiking interest rates really aggressively, right? 0.75 points for I think it was 4 straight hikes, and then slowed down and then stopped last summer. Rates settling at 5 and change, and remaining that way for the past 7 or 8 months. And look at inflation coming down. Now, as Dave, as you said, it's not a one-to-one interest rates come up, inflation comes down. It's a tool the Fed uses to try to manage this. But it's been really, really encouraging to see how we've gotten these results on the inflation side while maintaining unemployment at a really positive rate. I mean, full employment is 4%. So the unemployment rate being at 4% or lower means we are in a place of full employment in the economy. And we have been, even throughout this period of rising interest rates.
And Yusuf, we do have a question from the audience about the comparison between non-farm payroll with and without government payroll. The comment being, I've heard that a lot of hiring in the latter half of 2023 were government employment. I'm actually not sure that's the case, but I think you've decomposed those numbers more carefully than I have recently.
Yeah, I mean, what I would say is, I don't know that there's much to say about 1 month's worth of data. It may or may not be true that so much of that hiring was government-focused hiring, and yet the fact of the matter remains, if we look at the overall health of the economy, the employment numbers have remained strong, even as rates have continued to go up. So, Dave, I don't know if you would add anything there.
Well, the thing is that there has, what's happened is, you can see from the left-hand side, these green bars are showing that those are net new jobs that are being created. And so,
Correct.
the fact that new jobs are being created and the unemployment rate is not going up means that whether or not whatever proportion of those new jobs was in the government sector, we weren't losing jobs in the private sector at the same time.
Right.
Otherwise, the unemployment rate could be going up even in the face of rising employment. So I think it was actually pretty balanced across the board. And government employment, although we talk about government spending being a significant part of the total economic output of the economy, government employment is not actually a particularly large part of total employment within the economy. Private sector employment is still, I think, something more like 70+%, between 70 and 80% of total employment. Farm and non-farm labor, although there's not that much labor in the farming sector of the U.S. economy. Not anymore there is. 100 years ago there was, but I don't know if that helps, but I'm going to be interested to go back and look. The one thing I'm confident of, though, is that whatever the proportion of new employment was in these most recent net new job figures, clearly it was not at the expense of private sector jobs, or the unemployment rate would have been changing.
And Yusuf, we have another question here asking you to comment on the budget deficit as a factor in inflation, employment, and bond prices.
Wow. It's a great question. And I can recommend my personal favorite book on the topic. It's called The Deficit Myth by Dr. Stephanie Kelton. She put it out a couple of years ago. Disclaimer, she is a purporter of the modern monetary theory school of thought.
A deficit, she's an owl as opposed to a hawk, right?
Exactly. And the argument that modern monetary theorists put forth is that deficits in and of themselves are not bad. There's a chart, and it's a chart we've actually used in prior webinars, that shows as deficits increase, what it means is more money is going from the government into the private sector. And so the government's deficit is the private sector's surplus. And so that money has to go somewhere, and it flowing into the private sector then creates opportunity for more productive activity that feeds into the market. So, personally, deficits, to me, I have, and Dave, maybe you share the same view, they're in and of themselves, they're not bad. They are to be looked at and managed. And we're thinking about them maybe a bit differently than we were over the past, and this is a perfect slide to have up here. For several years, while interest rates were so low or at zero, the discussion about deficits changed, because it's like, well, so you have a deficit, it's contributing to the national debt. And yet with rates so low, does that change the way that we think about?
It's easy to carry the debt, right?
Exactly.
Professor and Dr. Kelton isn't making and other similar-minded economists, we're never making the point that deficits never matter.
Right.
It's just that deficits don't matter at a time when we have high unemployment and where there's a lot of excess capacity within the economy that could be mobilized. If you get into a period where where there's competition for resources between the government sector and the private sector, then you can get this crowding out phenomenon. But that has not been the case for most of the last decade and more. And will be more of the case going forward. But the thing we saw was that we were able to have a dramatic fall in inflation rates, even in the face of deficit spending, which is normally, again, classical economic theory would tell you that no, the level of deficit spending we were seeing should have caused inflation to continue at a high level, and it didn't. And I think one of the best explanations of the rapid drop in inflation was partly worked by the Federal Reserve, which cooled things a little bit, but it was also simultaneously, and maybe almost coincidentally, some of the COVID era disruptions finally sorting themselves out. We had supply chain disruptions that carried far beyond 2020. in which it was very difficult to get parts. When you have a global supply chain where parts have to flow from South America and Europe and the US to China, where things get assembled and then they have to flow back again to the final product markets. Any disruptions in those things, and we had a lot of disruptions because of COVID, caused shortages, and shortages caused rises in prices. So the Federal Reserve action on interest rates was surely a contributor to that rapid drop in inflation that we saw. But it also, again, coincidentally was happening at the same time that these COVID era supply chain disruptions were finally sorting themselves out.
Yeah, and let's not forget the other supply chain disruptions that were influenced by the war in Ukraine. And so there was so many different factors influencing what we're seeing. And so I guess maybe to close our response to the question is, I don't know that there's a blanket statement we can make about the relationship between all those factors on a forever basis. There's an assessment that we can make about those factors in a given moment based on what's happening. We can contextualize and make sense of what we're seeing. But it's hard to put a permanent relationship between all those pieces that we would expect to see unfold consistently every single time the economy goes through a shock.
Oh, and Jack is, I'm just going to jump in here, Yusuf, because Jack is asking a question about, whether or not the Inflation Reduction Act, the major piece of legislation, bipartisan legislation that was passed not long after Biden became president, if that's going to have be a factor in continued growth over the next few years, because at least in the U.S., as a consequence of seeing more onshoring of chip technologies, battery technology, and so forth. And I'm sure you have your take, and I would say yes. And in fact, that is, as is so often the case, that was a massive piece of legislation, but it isn't like you could spend $1 trillion overnight. It has to be, the economy can only absorb so much, the private sector can only absorb so much investment at a time. And so we've barely begun to scratch the surface of the ultimate impact of that, I believe.
Yeah, absolutely. No disagreement from me and nothing to add. This slide here that we have is the backdrop for interest rates and the path that they've been on over the past 50 years. It's interesting to note how dramatic the rise in rates has been in this most recent hiking cycle. And we made this point earlier, but I'll point to it again, Dave. As you mentioned, every time the Fed has raised interest rates, if you can see the gray bars here throughout the past 50 years, it's portended a recession. Not the case here. This really small recession that we saw was actually just caused by COVID, not this hike in interest rates that we were seeing in the latter part of the teens. But this might be the first instance of a dramatic increase in interest rates without a corresponding recession. Might be. Again, no predictions here, but so far, no gray bars on this chart. And ultimately, rates have flattened, and we do expect them to come down, although we don't expect them to come all the way back down to zero. Maybe 4% might be a place that they settle somewhere around there. That's not a prediction, just the sense that the Fed wants to have latitude after it's brought rates down to bring them down further in the event that it needs to create more capacity in the market without taking rates back down to zero.
They've got nothing left in their toolkit if they're sitting at zero. They could do quantitative easing, which was sort of a way of almost getting like negative interest rates. But this is the other thing that's notable is that interest rates, the Fed has always had this notion that the natural rate of interest, the natural risk-free rate that you ought to be able to get when you're just parking money, just deferred consumption, the risk-free rate ought to be somewhere between 2% and 3%. And the risk-free rate for a decade or more was more like 0%. But if interest rates remain higher long-term, that's also something that honestly it favors value stocks, which you all know that we tend to favor value. That's where you're buying a stock at a lower price relative to its earnings or its assets. We mentioned earlier that the level of interest rates is an input into the the calculations that investors make for what a stock is worth. And value stocks tend to do better when interest rates are higher than growth stocks, because value stocks tend to be companies that are producing earnings now. And so you're not discounting those earnings at a high rate of interest. Whereas growth stocks are often companies that are promising, high earnings in the distant future. And when interest rates are zero, it's like future earnings are worth a lot more in the present than when interest rates are high. There's like an opportunity cost calculation. And so to the degree that rates might be slow to fall, we think we're going to continue to see what we've seen since 2020, and that is that value stocks and small company stocks have been doing much, much better since we rebooted in that COVID, after the COVID recession.
Absolutely. So, couple of things to watch as the year unfolds. The Fed gets together next month. It'll be interesting to see whether or not they adjust interest rates, and then we've listed out their remaining meetings for the year. So more to come from us as the year shakes out. And then the other thing, you may have heard that come November of this year, there's going to be an election. We are watching along with the rest of the nation and the rest of the world, of course, to see how things unfold there. Again, we've noted some of the significant dates here, and we do want to note, because there have been a lot of questions we've been getting from our clients about what the implications of so-and-so or so-and-so winning the election might be. And we've commented on this in the past. The president matters, and markets and global economies are complex systems that are influenced by so much more than the one person who sits in the Oval Office. And so we're using this segment of our presentation today to note that in a coming webinar, either in the second or third quarter of this year, we'll be doing a focused presentation on how markets have performed regardless of who's been in the Oval Office. And we'll also be talking a bit about how our portfolio performed, irrespective of who was in the Oval Office, and just share that as context leading into the election at the end of this year. But we're watching just as everyone else, and fascinated.
Well, and I'll say on that point, Terry is asking a question about our, how concerned we are about the impact of a broken political system, and it's to your point. I mean, one of the things that politics looms large in our daily news broadcasts and in our daily newspapers, and we would never say politics doesn't matter. We would never say that there isn't some impact when Congress acts, or we have a president who's taking arbitrary action to the degree a president can. But at the same time, we think the bigger impact are the daily decision in the US, for example. On a daily basis, 330 million people are going about the business of earning, saving, spending, and investing. And those individual day-by-day decisions that those 300 plus million people are making aggregate up to what's going on in the economy. And that's not uninfluenced by what's happening in Washington, but it's not influenced as much as it might feel like it should be based on how much Washington looms large in the headlines. And the other thing to remember is that, to the degree Congress does anything, whether they're raising taxes or lowering taxes, or the Fed is raising interest rates or lowering interest rates, those feel like big levers that are directly affecting the macro economy. But in reality, to the degree those things have an effect on the macro economy, it's through how it changes the incentives of individuals. It's how it changes, higher rates or lower rates of interest, or higher rates or lower rates of taxation, change the daily incentives of the 330 million human beings here in the US going about the business of living their lives and making financial decisions for themselves and their families. And individuals are going to tend to adapt. And that's why the economy tends to be resilient. It's why ultimately the markets are resilient. And so we worry about that stuff, but we don't believe it's going to derail the economy or derail the markets necessarily. And it's also, we're investing in a big world that has a lot of different political regimes in place all over the world, not just in the US.
Well said, Dave. And with that, we've covered everything we plan to cover. And thank you so much, all of you, for being in attendance and for asking wonderful questions and engaging us throughout the presentation. Nothing more from me, sir. Anything else you would add, or any other questions out there, Lauren, that are coming in?
We got an amen from Tom Donald. Thank you, Tom. I truly appreciate that. And I have to say one thing, and I think I'm only partly to blame for this, but we were wondering, Yusuf and I and Lauren were wondering ahead of time if this would be like the first time in years that we actually came in the 30 to 40 minute range. And no, we're pretty close to an hour. So I don't know if we did our best, but we did what we're capable of doing anyway.
We certainly thought about it ahead of time. And Dave, if you're guilty, I'm just as guilty.
So for all of you,
all
of you with us now, I will note that that this has been recorded, and so if any of your friends or colleagues you think might be interested, Lauren, who I forgot to mention earlier, Lauren is not only a partner, she is our Chief Operating Officer for Yesky Buoy. She will be Lauren or someone she directs to do so will be sending out an email with a link to this once the recording's been posted online. So I'm not suggesting you'd ever want to hear this a second time, but someone who couldn't be here, you might want to pass it on and share it with.
Thanks for being here.
Yeah, thank you. And stay dry.